Let's talk about that global game. Joining us now is TD's Priya Misra, Jim Bianco of Bianco Research. Priya, the carnage in the bond market. How much worse can this get?
So I think we're in the midst of a repricing, I think a pretty big VAR shock in an environment where liquidity is not great. So trying to call the top in yields is tough. Inflation's high. I think the Fed is telling us they're on a mission here. So, the front end, I would say I'm staying away from that very front, the 0 to 5 year part of the curve. I do think if inflation, which is sticky, the Fed here is not letting the lags or is not willing to tolerate high inflation to let the lags play out. I think could the terminal rate be higher? We actually revised up our terminal rate to 5%. So that front end can certainly move higher. I do think the long end has value. I mean, given the volatility, UK rates move 50 basis points overnight, it's going to have a spillover in the US. But I think if you look at real rates, our view is that those real rates now are going to start to constrain growth. So, I think 3.5% to 4% on 10s is, it's going to be unsustainable for the US economy to handle that high long end rates. So that's where I see value right now. But, trying to call how high it can get with the market moving this much is tough right now.
Priya, you've broken it up quite nicely, the front end and the long end. So let's do that with Jim. Jim, the front end, we're repricing terminal rates everywhere. The Bank of England, we're looking for something north of 100 basis points. Through November, potentially. The ECB, we're now pricing another 75 basis point hike in October. Jim, do you assume that's still the direction of travel, that we're going to keep on repricing terminal rates higher into year end?
Yeah, I do. And as a matter of fact, the UK market might be looking as high as 200 basis points of yields on the front end by November. It has been stunning, the move that we've seen. The problem is nothing is broken. Now, financial markets are cracking left and right, but economies don't seem to be cracking, at least yet. Look at the United States. We've got a trend down in unemployment claims. We've printed 300,000 jobs every single month this year. We have very few signs that the economy is cracked. So without that, there's nothing to constrain the rise in yields. They'll just keep going up. The Fed will keep talking hawkish. They'll keep worrying about inflation until we see the economy crack. And I'm trying to differentiate that from the financial markets, which are cracking. You're going to continue to see that terminal rate creep higher. You're going to continue to see interest rates move up, and you're going to see financial markets stay under stress.
So, Jim, you're on the same page as Priya on the front end. What about the long end 10s? Priya's point here generally is that it's difficult to live with 4 to 5% interest rates over an extended period of time. Jim, do you agree or disagree with that?
I completely agree with that, but I would put a fine point on it that an extended period of time would be years, that if you were to get to 4% or something above that for a period of months, I think the economy can handle that. But if that is going to be the new equilibrium rate, where we kind of settle out and then we see rates vacillate around that, that will be a big problem for the economy with the amount of debt that we have and the coming repricing of debt service higher to those type of levels.
Equity futures right now down about 0.4% on the S&P. We're about 26 minutes away from the opening bell. Can you just spare a thought for anyone who's got a trade cable, sterling against the US dollar? Basically unchanged on the day now. Can I just give you the range? The high was 109.31 in the last hour. The low was 103.50 overnight. That's just the intraday trading range, and it's only 9 a.m. Eastern time. As for the global bond market, Treasury yields right now, they're higher. They were much higher this morning. They're up by 2 basis points at the front end, 422 on a 10-year, 373, up around about 5 basis points. Bank of America put out a note on Friday. Global bonds on track for the worst year since 1949. It has been that bad, that vicious, and we still have 3 months and change still to go. Katie Lyons has more. Hey, Kaylee.
Yeah, John, it's continuing even this morning, and that is not just a U.S. story. A lot of it in the last 2 days originating in the U.K. as fiscal policy, the idea of tax cuts and more borrowing in order to fund all the spending has driven gilt yields absolutely bananas. On the 2-year gilt yield, we're up more than 50 basis points on the day after a move of a similar size just on Friday. So we've already moved about 131 basis points over just the last week. And of course, at the longer end of the 10-year gilt yield, up about 92 basis points. And that has fed through the rest of the world, with treasuries up about 24 basis points over the last 5 days. This is actually the first time in 8 years that the 10-year gilt yield is above that of the U.S. Treasury yield. And on the subject of treasuries, I would note that with the moves we have been seeing, we have meaningfully broke out of a long-term trend. The 35-year downtrend in 10-year rates has turned around, and now it is back in uptrend, skyrocketing on the 10-year, up 200-something basis points so far this year. And with it, the bond bull market has come to an end. Global bonds are actually now down 23% from their peak last January. And while that may make it seem like bonds are a bad place to be, it still might be a better place to be than stocks. Maybe Tina is now actually dead, because if you look at the S&P 500 dividend yield versus the 10-year Treasury yield, back before the COVID-19 pandemic, it was 2.9% on that dividend yield relative to just 70 basis points on the 10-year Treasury. Today, we're talking 3.8 on the 10-year Treasury, 1.9% on that 10-year dividend yield. That is a gap of about 200 basis points and the widest gap since 2011, John.
What a change in the last 12 months. What a change in the last couple of months. Katie, thank you. Jim Bianco of Bianco Research, still with us. Jim, we've just blown up a decade of zero interest rate policy, a decade of it, of QE, trillions of dollars of negative interest rates. And Jim, you and I, Priya as well, we're all trying to work out whether we ever revisit that, whether any of that actually sticks. Do you think it does?
Yeah, if you're talking about going back to zero rates, I don't think, at least in this cycle, we're going to have to run through an entire cycle, probably one or two recessions, and then maybe the economy reorients itself and we could visit the idea of going to zero rates. But for right now, I think it's pretty obvious that the 35, 40-year bull market in bonds is over. We're in a period of higher rates now. How much higher and how long it's going to take would be the debate, and that really depends on where inflation peaks, how low inflation goes. Does it settle out at 2% or does it settle out at 4%? But I do think if anybody's hoping for those period of the pre-COVID period where the market goes to zero, the Fed prints money, and everything rallies because we've got liquidity sloshing around in the system, I think that is a bygone era right now.
So, Jim, what do you think will break the positive correlation between bonds and stocks? Because surely this doesn't hold indefinitely.
Well, it already is breaking to some degree. If you look at the shorter-term correlations, we're at a 15-year high. We've seen the price of bonds and the price of stocks move together to the most that we've seen basically since 2007. And any wealth manager that's managing a 60-40 portfolio knows this painfully well because both their stock and their bond portfolios are falling at the same time. Typically, when that happens, you get that positive correlation. It's in a period that people are worried about inflation. And we're in a period where people are worried about inflation. So what ends that? If we end the period of worrying about the inflation. Well, we might peak inflation soon, but that doesn't end the worry. The worry might come years later. So it's going to be a while, I think, before we see stocks and bonds revert back to what we saw between, say, 2000 and 2020.
Britt, can I get your thoughts on that? Because I think that's absolutely critical for a lot of people in this market at the moment. When do the risk mitigation characteristics return to bonds in a way that equities are lower and bonds actually appreciate and yields drop? Because at the moment, the epicenter for the pain, the poison, is the bond market, leading to lower equities. When do we break that correlation?
So I would say it's inflation to Jim's point, but also growth. At some point it takes a while. Monetary policy works with a lag. But are we talking 6 months from now? The unemployment rate starts to rise. That's when I think you have to revisit correlations because the Fed may not be able to respond. So the front end will not provide you any hedge. But what about the long end? Because at some point inflation comes down. It just takes a while. Growth slows down, starts to put downward pressure on wages. That then starts to impact CPI. Maybe it's a year out and the Fed starts to cut rates. In our view, they're going to be cutting rates pretty aggressively in 2024. But how do you set up for it now? Market's forward looking. So I would say the long end starts to provide that hedge the moment you start to see the economy slow down. So it's not just inflation. I think inflation is more about the front end. You have to pick your points in the bond market. Is it credit? I'm a little nervous about credit risk premiums here because the debt servicing cost starts to go up. I would say it's government bonds in the long end that start to offer value against risk assets because we know growth is still going to respond to that move higher in real rates. And I don't think the bond bubble in real rates is over because that's a function of demographics, of productivity. We haven't seen any of that change. Even if your inflation expectation and risk premium is higher, the real rate bond bubble is, I think, very much still here because these are very structural forces at play.
Priya, that is so important. Jim, can I get a final word from you on that real rates could remain suppressed?
Yeah, I mean, they could remain suppressed. And keep in mind that if you go back to 1954, Every cycle where the Fed was hiking ended with positive real rates across the entire yield curve. Chairman Powell mentioned that last week in his press conference. Now he's using core PCE, so he's using a 4.8% inflation rate, and we're nowhere near that across the entire yield curve. So if the idea is where do real rates peak, it isn't here. It's probably going to have to be much higher before we finally see that end, at least of this cycle.
Jim Bianco, Priya Misra, sticking with us. Shout out to Chris Harvey today as well. Chris published earlier this morning over at Wells Fargo. I've said this a million times, nothing wrong with being wrong. Chris is coming out and saying it. We've been wrong. He said the following: our belief that we wouldn't retest the 22 low until the first half of 23 was wrong. Despite retesting the lows, we feel the market bottom has not been established and stocks will make lower lows in 23 as EPS estimates come down and the Fed tightens into recession. It's that next shoe to drop that Mike Wilson and Morgan Stanley's been talking about for a while that we'll focus on with Tony DeSpirito of BlackRock a little bit later. Coming up on this programme, UK assets selling off in the wake of new fiscal plans.
Now we have that reaction in global financial markets to the irresponsible and reckless statement that we had from the Chancellor on Friday.
Sterling has had an absolutely wild ride today alone. That conversation up next.
And what I'm determined to do as Prime Minister, and what the Chancellor is determined to do, is make sure we are incentivising businesses to invest, and we're also helping ordinary people with their taxes. And that's why I don't feel it's right to have higher national insurance and higher corporation tax, because that will make it harder for us to attract the investment we need in the UK. It will be harder to generate those new jobs.
The UK's latest fiscal measures fueling volatility in risk assets, gilts plunging, the pound taking a wild ride after touching fresh record lows early this morning. The Shadow Chancellor weighing in.
That's not what financial markets want to hear. They want to hear that the Chancellor has got a serious plan for getting a grip of the public finances. We didn't hear that on Friday. We didn't hear it over the weekend. And now we have that reaction in global financial markets to the irresponsible and reckless statement that we had from the Chancellor.
My good friend Guy Johnson joins us right now from London. Guy, the range on cable, the high today 109.31, the low 103.50. What on earth?
I think the range is explained by the Bank of England, John. You can almost feel the energy emanating from the building over my left shoulder. They have a challenge now. What are they going to do in response to what we're seeing from the market? The market, John, is pushing. So you get the thin liquidity in the Asian session overnight. The pound plunges, continues basically the move that we had out of Friday into the weekend. So we reopen in the Asian session. Low liquidity goes down sharply. Then markets start pricing and pushing the Bank of England. And that is what you're seeing in cable right now. You are basically seeing the market beginning to price what we're seeing in the gilt market, which is the Bank of England responding. And we've seen throughout the morning, headline after headline after headline. The market is now pricing the Bank of England to do X. Now it's X plus 1. Now it's X plus 2. The market is pushing the Bank of England. How does the Bank of England respond to this calmly? How does the Bank of England respond to this without looking like it's panicking? That, I suspect, is the question that is being asked and hopefully answered over my left shoulder at the Bank of England.
Guys, the domino after that interests me a whole lot more, and I know this is tremendously difficult to game out. What we've got here is the spiral that follows. You've got looser fiscal, which means tighter monetary. I'm trying to work out whether that means looser fiscal after that, and what the response of the government would be if the Bank of England validated what is currently priced.
So that I think is what changed over the weekend as well. You heard from the Chancellor, and the Chancellor seemed to imply that further tax cutting could happen. Now, would that further tax cutting happen in response to the Bank of England stabilising and the kind of spiral that you're talking about? But he certainly threw a little bit of extra gasoline on this fire over the weekend by suggesting that he is not done and that spiral could continue. The other challenge the Bank of England has as well is that if it were to curtail its QE, would it look like it is helping the government out and therefore effectively financing indirectly what the government is proposing? Huge questions for the Bank of England.
Massive debate right now, Guy, that we're all having with our guests on whether what we're seeing at the moment is just the required adjustment through higher yields and a weaker currency to attract capital to finance a big deficit, or something disorderly? The beginning of a self-fulfilling downward spiral as such. From the people you speak to, Guy, is it the former or the latter?
I don't think we know yet. But the balance is beginning to shift, isn't it? This doesn't feel orderly at this point. You haven't seen these kinds of moves for a very long time. As ever, John, the adjustment is one thing, A to B. It's how fast you get there, I think, is the real critical question. There is an argument to be said that this is a country that needs maybe a lower tax burden to encourage a more vibrant economy. Now, that's just the first step on a journey, but maybe that is required. But you are trying to introduce that into a fairly febrile market right now. We know that, which is why this becomes more challenging. So it's the scale and the speed of response, and I think it's the latter that I think is really interesting. This country clearly does need to make some changes. I think a lot of people would agree with that. How you do that and how quickly you do that is the question here. And I think that is what the Bank of England is going to be looking at very carefully. It's not necessarily the ultimate journey, it's how fast it takes the country to get there.
Hey, Guy, always great to catch up, buddy. Looking forward to the coverage in about 41 minutes' time. Guy Johnson and Alex Steele are going to guide you through the close, the European close, and pick up on this story as well. Priya Misra, can I throw that question at you? It's kind of the important one right now. Are we seeing just the required adjustment through higher yields and a weaker currency to attract capital and finance this deficit, or are we seeing something disorderly, some kind of self-fulfilling downward spiral?
I would say right now it seems very disorderly. Depending on how the Bank of England responds, they will determine which way it goes. You know, if there's a sign that they're not independent, they're actually facilitating this move, I think it becomes disorderly much faster. And, you know, at that point, you have to sort of question the independence of the central bank. Are they committed to the inflation target? I mean, this is a giant experiment that the UK is undertaking. And is the Bank of England going to be an enabler? Or, you know, are they going to fight it? I think the gilt sales that are supposed to start next week, I would argue it's very hard for them to say that they can sell in a market. It's going to get much more disorderly. So I think, you know, maybe postponing it by a month, that is something we do expect that they do. Some sort of verbal intervention, that they are there to support the market for liquidity. You know, I think all that we get. Anything larger and no, you know, or rather a pushback on intermeeting hikes, or even if they don't do an intermeeting hike, pushing back on that terminal rate, I think will make the, you know, I think that's when that downward spiral accelerates. Right now, we're still waiting to see. I mean, they just had a meeting last week. I have to think that the Bank of England had an idea of what the fiscal side was doing. They still went with, you know, 50, not 75 basis points. So I think they might be trying to just gradually raise policy as opposed to, you know, act like they're facilitating. But any sign of facilitation or that they are working together, I think does take this to another level.
Priya, how well understood do you think the gilt market actually is? Given the average maturity is 15 years, the debt pile is dominated in sterling. How well understood do you think that is?
Right. I think which is why the gilt sales were necessary, because just passive runoff, what the Fed is doing, was not possible. But the UK market's also very much a domestic market. The pension funds are very large holders of long end paper. I'm sure they're now questioning, you know, where do gilts end up? I mean, if you have high inflation, high fiscal, I mean, the government's talking about tax, about spending cuts. But in an economy that's in recession, I think you have to question whether they'll be able to get these you know, spending cuts done next year. They didn't align the tax cuts and the spending cuts, and I think that is going to make people question long term, where should these gilt yields be? And I think that then has ripple effects across asset allocation within the UK. So it's a less liquid market, I have to say. We're getting used to seeing very large moves in gilts. So it is a different market than bonds. But there are big spillovers between what happens in gilts and bonds and treasuries. So I think we should all be paying attention, even if you are not involved in the gilt market.
Jim, Bianco, I wanted to give you the final word. We've heard repeatedly over the last week, this is a big risk. It's an experiment. Why is it the wrong one?
Well, because the UK has an inflation problem, and the Bank of England came out in August and said that in Q4 they would be in recession. Now, Q4 Saturday, so I guess we're in the final week of not recession in the UK. And now that they're going to cut taxes, cut regulation, you're going to inject massive stimulus into the UK economy. Let's assume that works. Let's assume they get what they want. That portends much higher inflation. That portends more volatile markets as they try to adjust to the idea that the inflation rate is going to ratchet even higher. And so we're in for a thrill ride. You know, you asked if the markets were disorderly, and I agree with Priza that last week, no, this week, maybe, that they are, you know, on the way towards becoming a lot more disorderly.
I say things have settled down. Intraday, the 2-year in the UK is still up about 50 basis points. So still seeing some major moves. Priya Misra, and Bianco, to the two of you, thank you. Sterling, just about unchanged. Up next, the morning calls, and later, Tony DeSpirito of BlackRock. This is Bloomberg.